Hey guys, it's Brian Taylor with Dreamline Realty in Charlotte, North Carolina. And today's video topic is about FHA loans. So many people come to us every month that need to get mortgage financing and they just don't understand what an FHA loan is. But that's where we come in. This video today is going to talk about exactly what that loan program is, how to qualify for it, who it's for, and some pitfalls to be aware of if you go after this type of a mortgage. And also at the end of the video, I'm going to give you a payment calculator where you can go in and put in some different variables and calculate some payments and a bunch of other stuff. So stick around for that, and we're going to get started right now. So welcome back to the channel, and today's topic is about FHA loans. And if you've been following the channel for a while and have not subscribed, or if you're new to the channel, go ahead and click that little box in the bottom right hand corner that says subscribe, and then click on the bell to be notified when we put out new videos every week. So over the next 30 days, I'm going to be doing videos on conventional loans, VA loans, and USDA loans. So you're not going to want to miss that. But for today's topic, it's all about the FHA loan. So let's go ahead and dive right in. Okay, so we're going to talk about FHA, and we're going to talk about what this thing is. So FHA stands for Federal Housing Administration, which is part of the United States Department of Housing and Urban Development, otherwise known as HUD. And FHA's purpose is to provide mortgage insurance on loans that are made by FHA approved lenders. So FHA doesn't actually process the loans or underwrite the loans, they simply insure them. So that basically means if you go to your local lender and get an FHA loan, that local lender is going to be the point of contact. They're going to process the loan, they're going to underwrite the loan, and they're going to close that loan. But the guarantee is that that loan is insured. So if you as the buyer default on that loan, the lender is protected from the loss. So just keep in mind, if you think about going after an FHA loan, your loan isn't going to go to some other city across the country to be processed. It is going to be handled right there with your local lender. And again, the lender is insured in the event that you are to default. So most local lenders in Charlotte are FHA approved, and of course most banks are as well. So if a local lender wants to do FHA loans, they have to go through a series of steps with the FHA to get the FHA approved status. And once they have that, they can offer the FHA loan. But what FHA does do though is they do have guidelines that all of the lenders have to follow. And the FHA has actually set a minimum credit score of 580. Unless you're putting down 10%, then they have a minimum credit score of 500. However, big key here, lenders that give these loans out don't necessarily follow that credit score guideline, right? So a lot of the lenders, even though they could go down to a 580, most of the lenders around Charlotte are going to require a 620 or a 640 credit score because they want to be protected as much as they can from making bad loans. So FHA does slap the hand of lenders that make bad mortgages. So if a lender makes a lot of bad mortgages that default, FHA can pull their approval status, and they don't want that to happen. So that is why they have their own minimum credit scores, and they have years and years of data to go back on and tell the defaults that have happened and what those minimum credit scores were for those people that defaulted. So that is the reason why they come up with their own credit score guidelines. So just want to be really clear on that. Now, FHA loans have a minimum loan amount. So every January, FHA will come out and they'll say, okay, for the Charlotte area, your minimum loan amount is this. So for right now, as I'm recording this video in August of 2021, the minimum loan limit, or the maximum loan limit, I should say, for the Charlotte area is $356,362. And what that basically means is you can buy a house that's priced at $400,000, but FHA is only going to give you $356,362. So you would have to put down the difference between $400,000 to the $356,362. So, you know, a lot of people have to go FHA due to some of the more lenient requirements that FHA loans provide. And they can purchase whatever price they want to, but they can only get a certain loan amount. So that's what that means. And some of the differences between FHA loans and conventional loans, as I had just mentioned, there are more lenient underwriting guidelines in some instances than conventional loans. And they also offer the buyer to have a slightly higher debt to income ratio. So that's the good news with FHA, is you can stretch your buying power just a little bit more on an FHA than a conventional. And as I also mentioned, the more lenient underwriting guidelines, you know, they're a little bit less lenient if you've had a bankruptcy or if you've had a foreclosure. You know, a FHA loan will allow you to get another FHA loan or your first FHA loan if you've been 2 years out of bankruptcy, where a conventional loan is going to require you to have a 5-year period out of that bankruptcy. All right, so some properties are not eligible for FHA financing simply due to the condition of the house. And if you go for an FHA loan, when an FHA appraiser goes out to do the appraisal, there's certain items that they're going to be looking for, and that is designed to protect the buyer, right? So FHA is looking for things, they've got a thing where they're looking for safety, security, and soundness. So they want to make sure that that house is safe, they want to make sure that that house is secure for the buyer, and they want to make sure that that house is sound and the whole thing is not falling down. So a few things to keep in mind. Houses built before 1978 could contain lead-based paint. So in 1978, anything built after that time frame, lead-based paint was not a thing anymore. But prior to 1978, everything was built and painted with lead-based paint. So that's a safety issue. So if there is lead-based paint on a property, any peeling paint must be scraped and repainted. And this applies to interior and exterior surfaces, including sheds and garages. And we see this peeling paint on these older homes a lot of times around windowsills. And actually, one of the very first transactions that I did years and years ago when I was a really new agent, I did an FHA loan for somebody who bought a property who had a shed that sat behind the house. And I learned a lesson really quickly on that transaction. I totally blanked on the idea that there could be lead-based paint on that shed. And when the appraiser went out to do the appraisal, that whole shed was peeling paint. And the seller had to scrape all of the paint off the shed and had to completely repaint the shed. Now, thankfully, that deal ended up working out. The seller desperately needed to get rid of this house, so it worked out. But in a normal situation, that would have been a deal breaker right there. The amount of time it took to scrape all of that off and then repaint it was days. And on that particular house as well, inside the house, around all of the windows, all the window seals were peeling paint as well. So they don't want anybody to have to be exposed to any of that paint. If there's broken windows in the property, those will need to be replaced with new windows that are not broken. If there are stairways on a porch or a deck that are missing the handrails, or if they're missing handrails on the stairway inside of the house, FHA will require the appraiser to note that, and handrails will need to be installed before that loan can close. And the same thing applies for flooring. So if you're looking to buy a home and it's missing carpet in one of the bedrooms, FHA will not let that close. It has to have flooring installed in order to make that loan good. And another thing that we see a lot of times is wood debris in the crawl space. Any kind of wood debris in the crawl space needs to be removed because that's a major invitation for termites. And again, that would be a soundness issue that FHA would not want that foundation or the substructure and the floor joists to get termite activity in there because there is wood debris lying on the floor of the crawl space. So those are a few things to keep in mind of why FHA is a little bit different than a conventional loan. All right, moving on. So as far as the components of a loan go with FHA, they will allow you to buy a house with just 3.5% down payment. And one of the big misconceptions is that FHA loans are for first-time home buyers, and that is not true. This is not a first-time home buyer loan. Anybody can get an FHA loan, even if they've had an FHA loan in the past. So that's the good news. A lot of conventional financing programs are going to require a borrower to put down 5% down payment, sometimes 10% down payment or more depending on credit score. But FHA is only 3.5%. And one thing to keep in mind, is closing costs are separate from down payment. So a lot of people will come to us and we'll get them started on the loan process, and they'll have enough money to cover the 3.5% down payment. And sometimes they think that's all they need. That is not the case. In addition to that 3.5% down payment, they will also need closing costs. So keep that in mind. And closing costs run on a rule of thumb basis about 2% of the loan amount. As you start getting into the higher loan amounts in the higher 300s, that percentage is probably going to be a little bit less than 2%, but that's a good rule of thumb. And your mortgage lender can break down all of these numbers for you. If you go to get pre-qualified, they'll tell you exactly how much you'll need for the down payment. They'll break down your closing costs, give you a total number that you're going to need to bring to closing as an estimate. Things can always change, but generally the lenders are going to be really, really close. So you know up front how much money you're going to need to put the whole deal together. One of the things about FHA loans is there is mortgage insurance that is paid up front, which is financed into your loan amount. And I'm going to go through a whole payment thing at the end of this and show you how this breaks down. But there will be monthly mortgage insurance on the loan, and it's calculated at 0.0085% of your loan amount. So basically, if you were to take your loan amount times 0.0085 and then divide that number by 12, that's how much money you're going to pay on a monthly basis that'll be included in your payment. And then they also have an upfront mortgage insurance premium, which is 1.75% of your base loan amount. So basically, once you calculate and deduct the 3.5% off of your sales price, then they tack on 1.75% of that number, which will be your total loan amount. And the monthly mortgage insurance, it's different than a conventional loan. So on the monthly piece, on a conventional loan, once you reach 20% equity in the house, you can get rid of the mortgage insurance on the conventional loan. The monthly mortgage insurance on an FHA loan will stay there for the life of the loan. You cannot get rid of it. So we'll go through this example in a minute, which will hopefully make a little more sense about those things. Now, one thing that is really important, several years ago when the market crashed in 2008, in that time frame, FHA came out with what they call a 90-day flip rule. And that means that you cannot get an FHA loan on a property that has not been owned for 90 days by the current homeowner. And that is a way to protect the borrower from overpaying on an FHA loan. So when you've got houses out there on the market right now with these iBuyers like Opendoor and Zillow, those companies will come in and pay cash to the seller, so they don't have to have showings and that their whole model there. So if you're looking at a property that's listed with Opendoor or Zillow or Knock or any of these other iBuyers, those people cannot get an FHA loan on those properties until Zillow or Opendoor have owned that property for 90 days. I think it's kind of a goofy rule, but that's just me. But that's the FHA policy. That's what everyone has to adhere to. So if you're looking at one of those properties, just know you're not going to be able to buy that home unless it's been sitting on the market for 90 days. All right. So what I want to do now is I want to go through a payment calculator and show you guys exactly how to calculate a payment. And I'm going to give you a link below in the description of the video. You can click on the link and get access to this payment calculator, and you can play around with your numbers, figure out kind of what your payments are going to be based upon your taxes and insurance, and you'll have access to all that. So let's dive over there and I'll show that to you now. Okay, so here's basically a simple payment calculator, and it's not only going to tell you about your payments, but it's also going to break down your loan amounts for you. Where I was talking about the upfront mortgage insurance premium, I'll go through that with you in detail. So if you click that link in the description and you have access to this, all you have to do is change the numbers in yellow and everything else is going to calculate for you. So that's real key. Don't go down here in the bottom section under the orange and start clicking anything in there. That's going to mess up the formula. All you have to do is change the numbers in yellow. Okay, so we're going to be doing a sales price of $250,000. And let's just say that your interest rate is at 3.25%. Okay? Now, One thing you'll have to figure out is what your annual taxes are. But on a house that's priced at $250,000, your annual taxes will probably be somewhere around $2,500 a year. So that's what you plug in there. And then your annual homeowner's insurance on that size house is probably going to be around $1,000. So I'll leave that number in there. So when we go down below at the bottom, this is where all the magic happens and the calculations come in. So the sales price pulls from the sales price that we put in the yellow. All right, so what that means is FHA says that you have to have 3.5% down payment. So what this is telling us is that $250,000 minus your 3.5% down payment gives you what's called a base loan amount of $241,250. It's from this number here, the $241,250, where FHA is going to require you to pay 1.75% on top of the $241,250. That means that your upfront mortgage insurance premium is going to be $4221.88. So if we take that $4221.88 and add it to the base loan amount, that gives you a total loan amount of $245,472. So that's what your payments are going to be based off of. So that at that interest rate and that loan amount, that's going to generate a principal and interest payment for you of $1,068.31. The taxes are broken down. The $2,500 that we put in here for taxes divided by 12 means $208.33 in taxes. And then the same thing for your homeowner's insurance. $1,000 divided by 12 gives you $83.33 in your homeowner's insurance. And then this is the monthly mortgage insurance premium. So this is taking your loan amount of $245,472 times that 0.0085 divided by 12 gives you your monthly mortgage insurance premium of $170.89, giving you a total payment of $1,530.86. So this is the beauty of this little calculator. So for example, if you really wanted to play around, you could say, okay, I'm looking at a house that's priced at $340,000, but my interest rate that my lender told me is going to be at 2.875, and my taxes I know are $3,200 a year, and my homeowner's insurance is $1,200 a year. Again, only changing the numbers in yellow. That recalculates everything for you, giving you your new base loan amount of $328,100, your new upfront mortgage insurance premium of $57.41, total loan amount $333,842, and your new payment of $1984.16. So again, click on that link in the description. You can grab a copy of this. Just make sure if you click on that link, it is in a Google Sheets format. So when you open it up, just go up to the top, click File, and then make a copy. That way, if anyone else is in here, all the numbers won't get messed up. If for some reason that you do mess up the formulas and you still want this calculator, just shoot me an email and I'll go in there, I'll make the changes and fix it for you and send it back out to you so you have it working correctly. All right, so that is that. Hope you guys enjoy that, and hopefully that's helpful for you. Hey, thanks again for watching that video with me today. I'm super excited to bring you more good content around other loan programs coming up. And if you want to get a copy of my book called Buying Your Dream Home, where I break down the whole entire home buying process, there's a link in the description for that as well. And you may want to watch this video where I talk about how crawl spaces can be the #1 thing that kills a real estate transaction. Thanks for watching. Make it a great day.